Somebody told me 2025 was going to be the year everything finally made sense financially. They were wrong. I watched people pour money into AI stocks like they were buying lottery tickets at a gas station. I watched bears on Twitter call a crash every single week, and I watched the market just keep going, grinding higher, defying logic, defying gravity, defying every spreadsheet I had open on my second monitor. And honestly, I didn't know what to do with that. Because on paper, nothing added up, but in reality, everything kept climbing anyway. I've spent the last several months reading earnings reports, tracking Fed decisions, watching where institutional money was quietly moving, and trying to figure out what 2026 actually looks like for regular people who are trying to build something real with their money.
And what I found wasn't clean. It wasn't a simple bull case. It wasn't a simple bear case. It was something messier, something more uncomfortable, and something that almost nobody is talking about right now. So let me just be straight with you about what I actually think is coming. Let's start with the part that keeps me up at night. Because if you look at the numbers honestly, the AI trade is stretched in a way that's genuinely hard to justify with a straight face. NVIDIA is trading around 47 times earnings. Palantir somewhere around 400 times earnings. Datadog is sitting above 430 times earnings. 430 times earnings. At that point, you're not investing in a company, you're investing in a feeling. You're pre-ordering a future that hasn't been built yet, and you're paying full price for it today.
And the problem isn't just those individual stocks. The problem is what they're dragging along with them. When NVIDIA moves, semiconductors move. When semiconductors move, the entire tech sector moves. When tech moves, the S&P moves. And suddenly you look up and realize the S&P 500 is trading at nearly 31 times earnings. The historical average is around 16. We are sitting at nearly double the long-term average. And here's what makes that even scarier. The S&P 500 is supposed to represent 500 companies across dozens of industries. That's the whole pitch. Broad diversification. Spread your risk. Sleep at night. But right now, just 7 companies account for over a third of the entire index's market cap. Through the first 3 quarters of 2025, the Magnificent Seven drove over 41% of the S&P's total returns. That's not diversification. That's a group project where 2 people do all the work and everyone else puts their name on it.
And passive investing is quietly making this worse. Because most index funds are market cap weighted, meaning the bigger the company, the more of your money automatically goes into it. So as these tech giants grow, they absorb more and more of every new dollar flowing into index funds. It becomes a feedback loop. Beautiful on the way up. Absolutely brutal if it reverses. Because a 10% pullback in NVIDIA doesn't stay in NVIDIA. It bleeds into the NASDAQ. It bleeds into the S&P. And suddenly, a portfolio you thought was diversified is having a full-on panic attack because of the mood swing of one stock. I'm not saying a crash is coming tomorrow. I'm genuinely not. But statistically, we are overdue. Since 1954, the S&P has averaged a correction of at least 10% roughly once every 3 years. We've had several years of outsized returns. History doesn't care about your feelings on that. But here's the thing I had to learn the hard way. Being right about valuations doesn't mean you're right about timing. John Maynard Keynes said it best, markets can stay irrational longer than you can stay solvent. Michael Burry figured that out recently too. You can see the cracks forming in the foundation and still watch the building stand for another 3 years while you bleed out waiting for it to fall. That's the trap of the bear case. The logic is sound. The timing is unknowable. So what's the bull argument? Lower rates. That's really what it comes down to. The Fed delivered 3 consecutive rate cuts to close out 2025. Going into 2026, the expectation is at least 1 more. And when rates drop, capital gets cheaper. When capital gets cheaper, valuations get easier to justify. When valuations get easier to justify, investors start paying premiums for future earnings again. Risk-on assets wake up. Liquidity loosens. The whole system exhales. That's how markets can keep grinding higher even when the economic data feels mixed and uncomfortable. Cheap money is a powerful drug.
And then there's fiscal policy, which barely gets talked about compared to what the Fed is doing, but honestly might matter more in the short term. The U.S. government is running a deficit of over $1 trillion annually. I've talked about how damaging that is long term, but in the short term, that spending is real money hitting real parts of the economy. It supports consumer demand. It props up corporate revenues. It keeps activity running even when organic growth slows down. And that spending doesn't stop overnight. Programs don't get canceled on a Tuesday. Budgets don't get slashed between lunch and dinner. Politicians don't win elections by promising to cut everything and tighten the belt. So even if things cool down, the fiscal floor holds for a while. That's the bull case. Cheap money, plus government spending, plus an AI story that hasn't fully played out yet.
But here's where I land after sitting with all of this. The most likely scenario is the one that basically nobody is positioned for. Not a melt-up, not a crash. Something in between. Something far more frustrating than either of those. A long, choppy, sideways year. A market where headlines flip every 2 weeks. Where rallies stall right as your confidence builds. Where dips feel scary but never deep enough to be real buying opportunities. Where capital just rotates between sectors with no clear trend, and every decision you make feels slightly wrong. These are the markets that quietly destroy portfolios, not because of one big dramatic crash, but because of slow, grinding impatience. Because people make emotional decisions in environments that punish emotional decisions. The crash is easy to prepare for psychologically. The melt-up is easy to ride, but the long, sideways grind, that's where most people get hurt without ever fully understanding why. Here's what I think you actually do with all of this. You stop trying to predict the exact outcome and start building a portfolio that can survive multiple outcomes. That means not being over-concentrated in any one theme, no matter how convincing the story sounds. It means being honest about how much volatility you can actually handle without panic selling at the worst possible moment. It means keeping some dry powder so that if a real correction does come, you have the ability to act instead of just watching. And it means accepting that the smartest move in an uncertain market is sometimes just not doing something stupid. I've made that mistake before. I've watched a position drop and convinced myself I needed to do something, anything, just to feel in control. And most of the time, that move made things worse. Impatience dressed up as strategy is still just impatience.
The honest truth about 2026 is this. Nobody knows. I don't know. The analysts on TV don't know. The guy with the 200,000 followers on Twitter definitely doesn't know. What we have are scenarios, probabilities, patterns from history that rhyme but never repeat exactly. And the people who come out of years like this the best aren't usually the ones who predicted correctly. They're the ones who built something sturdy enough to survive being wrong. That's the whole game. Build something that doesn't need you to be right every time. Because you won't be. Neither will I. And if someone tells you they've got 2026 all figured out, they're either selling something or they haven't been doing this long enough to know how many times the market has made fools out of people who are completely certain. Stay sharp. Stay humble, and pay attention to what the market is actually doing, not what you think it should be doing. That gap right there, between what should happen and what actually happens, that's where most people lose money. Don't be most people.